At the world's biggest wealth management forum held in Monaco in June, the three hottest topics were artificial intelligence, private markets, and the equity markets outlook. Will Hamilton from Hamilton Wealth Partners attended the IM Power Incorporating Fund Forum conference in Monaco and joins me now to share his observations. Good afternoon, Will. Thank you for coming in.
No, thank you, and good to see you, Danny.
Yeah, absolutely. So, AI, the buzzword. Tell us about what the conference had to say on AI.
Well, look, it dominated the discussion by a long way. But, you know, I think the questions that came out were, how do you make money out of it? You know, because you've seen, 7 to 10 stocks really run. And in fact, I was talking to somebody today and they said, they had invested in a battery business which supports data centres, and it's up 70% this year. So you're sitting there going, wow, just because it's sort of on the fringe. But someone asked a really good question, and they said, so how do you make money out of this? And someone said, well, look, every CEO of every listed company out there is probably looking, what do we do about this? So they bring in the consultants, so you buy Accenture. Now I look, to be quite cynical, but I thought, that's a really good answer.
It is a good answer. It's a bit like, how do you buy emerging markets? You buy Unilever or Coca-Cola. It's a different way of playing it.
Heineken,
Yeah, exactly. So in terms of, was there lots of talk around AI being in a bubble, or is it very much like having to be very stock specific about how one actually invests in this?
Look, if I didn't hear it once, I heard it a million times that Amazon changed the way shopping occurred by bringing in online shopping. But before it did that, it fell 92%. So I think the perception from a lot of people was, yes, it's a bubble. But everyone said, look, this is for real, and all the stats that you hear that, 1 million users within 5 days, etc. And it's broken all these records. And everyone said, look, it is game changing and it is transformational. There's no doubt about that. But things have run very, very hard.
Yeah, they have indeed, and it's also, I think, for investors understanding the different components between the picks and shovels, like an Nvidia, for example, or a Microsoft and the data centers, versus companies that start to embed it in their actual business and how much benefit they're going to get from monetizing that. And that seems to be the big question to me, is how big the uptake is and whether or not companies can monetize this to make money, better margins, better productivity.
I agree, and I think that we're all looking at it, and how do we introduce this, and what will it change, and will it lead to cost changes and for us? But I think that the example the person gave with respect to Accenture, I thought was a really good answer because it's logical.
Indeed, indeed. Well, let's move on to private markets and what you call the democratisation of private markets. So can you explain what you mean by that?
I don't call it that. This was a new buzzword that I heard and I've learned. And there's look, in Europe, people are bringing private markets to retail clients. Now, it raised my eyebrows, I'll admit that, when I heard this term and the democratisation. There's no doubt. When I'm talking to other wealth managers, especially in the UK, I said, well, where's this coming from? And they said clients. So they're not making the money that they were making in listed markets. They've heard about what's happening in private markets. So it's demand driven from clients. But look, we've used private assets in our portfolios for a decade. But very careful with respect to the asset allocation parameters around each various sub-asset class, infrastructure, real estate, private debt and private equity. But there seemed to be this sort of this fury towards it, and just because it's available doesn't mean you should do it. And retail clients, I just kept thinking, well, if you can make more money in private markets, and suddenly this wall of money comes in from retail clients, everything reverts to a mean, doesn't it, and averages out. So, I just sort of thought talking about bubbles, I just thought this is a little bit of a trend, and was one that was worrying.
Yeah, and so what are they doing? Are they sort of setting up feeder funds for basically retail investors to be able to get access? Because normally you've got to be wholesale or Hinwe or something, and you've got to have huge diversification in a private market. Is that basically how they're doing it?
Liquidity sleeves as well, So they've got a semi-liquidity. Some of them are daily, some of them are quarterly, but they're semi-liquid.
With my cynical hat on, and we both come from the other side of the fence, it would be like they've figured out that there's a big pool of liquidity that wants to go there. So if there's demand, we shall provide.
Correct. The ducks are quacking, feed them.
Exactly. Okay. There's a lot going on with central banks and the bond markets at the moment. The RBA obviously paused again.
Yep.
Look, how are you reading it at the moment? Because it looks like bond markets are starting to get a bit volatile and a bit tetchy at the moment.
I do think the bond markets, interest rates are at or near their peak, and that was a theme that came out repeatedly. When we saw capital economics, and that was a theme. And if you did see a sell-off in bonds, we saw bonds a month ago even got to 4.3 here in Australia. So they're levels where you look to top up. But I think that we are now looking at a soft landing. There's no doubt about that. And when interest rates get at or near their peak, that's a time at the right levels to look at bond markets. But at the same time, I think that this disaster scenario people were looking at with respect to a large sell-off in the S&P 500, I don't think that's probably going to eventuate. I think, look, don't get me wrong, there could be some volatility. There probably is going to be some volatility out there, a little bit of downside, but not this big sell-off that people were looking for. And when it comes to bonds, you've just got to buy at the right level. I'm not a bond guy, I'm an equity guy, but I think that that at or near its peak is traditionally been the time also to support bonds. But you just got to look, yes, you're right, the volatility, it's been incredible. As I said, it was at 4.3, then it rallied to 3.8.
Because the Treasury issuance numbers that have come out are pretty chunky, and they're going to, I think, announce tomorrow morning their time the structuring of that issuance. Do you think that's going to potentially pose some more volatility to the bond markets?
Look, it could. I think at the moment what we're seeing is that word volatility. It's out there, and but it's interesting. I think that on the equity side, just to change that a little bit, just some of the stats that starting to hear. I was listening to a podcast and they said that the bond equity yield differential is, you haven't seen this since 2001 on the S&P 500. So bonds having sold off, equities having rallied, especially the S&P 500, and you're looking at again, some stats I saw today showed that the S&P 500, not the S&P 500, but the US market as a percentage of the MSCI ACWI, it's nearly 68% at the 30th of June. Huge.
Yeah, absolutely huge. Reverting to mean springs to mind occasionally, Bob Farrell. But nevertheless, under a soft landing scenario for the US and here for Australia, by way of example, where would you be positioning within equity markets, as in geographically, which areas do you like, and also possibly sectors? Yeah,
so I think that we've just talked about the caution towards the US. We have just neutralised our developed market equity weightings, ex the US. So looking at Europe, looking at Japan, and also that differential between valuations on mid caps and large caps. It's a long time since you've seen a gap in that valuation. So very much looking at that mid caps. And look, don't get me wrong, I think that if we sort of see this soft landing scenario, you want to be positioned more towards growth.
Right. So when you say growth, are you talking cyclicals or industrials, or are you talking growth
correct.
stocks?
Absolutely, towards those cyclical industrials. I'm not talking, we always need to bear in mind valuations.
Indeed. Do you like emerging markets?
Yes. So we're more neutral there. But when we talk about emerging markets, it's, what you've seen is India. It's rallied very strongly. The exposure we've had has supported very much seeing India, and that's produced some very, very solid returns. We haven't been long China, but there's, as you just said, a lot of Southeast Asia has actually done very well as well. So Korea and Taiwan have done well on the back of semis as well. So you've got to choose managers, and I think this is the really important thing in emerging markets, that protect themselves on the downside as well.
Indeed. Was there much talk about China and the fact that they're struggling in this post-COVID recovery?
Surprisingly, no. There wasn't a lot of talk about China. And yes, I think that was a surprise. The focus was very much off. I think China has struggled. It hasn't been in the limelight for a number of years. So when it comes to equity markets, that is. So that just the focus just wasn't on it. But someone said to me today, the valuations in China are starting to look very attractive.
I think KWeb, the ETF, also has been running a lot of those tech stocks. Any warning bells that were issued over at the conference? Any potential black swans or something that anybody, apart from saying, high valuations?
No. Well, to me, the big warning bell was this democratisation of private markets. It was a new term, but yes, to me that was the biggest warning bell I heard.